What's up, guys? I'm Nobody Special, and my favorite of the shiny metals, silver, is up big today on the back of a very disappointing jobs report that came out, and we are going to get into that. Now, let's shrink my big fat melon of a head and talk about this jobs report. All right? Headline there is very, very disappointing. Jobs report disappoints. Only 235,000 positions added versus expectations of 720,000 jobs. I'd like to know whose expectations those were because that is quite a disappointment. All right, coming in at about a third of what they were expecting. So here's the deal with this, right? The big question on Wall Street's mind right now is taper. Is the Fed going to taper their asset purchases? Are they going to stop printing money, $120 billion a month, at least every month, and pumping it into the MBS market and the Treasury market? Well, they've said, Jerome Powell has come out and said, I want to see substantial further progress in the jobs market before we taper. Well, this does not look like substantial further progress in the jobs market. This is anemic at best. I mean, keep in mind, we need to be adding something like 100,000 jobs a month just to keep pace with the rate of population growth. So, and in the wake of the 20 some odd million jobs we lost during the pandemic, this is a long way from substantial further progress. So this is causing Wall Street to doubt whether or not the Fed is going to taper starting in September, like a lot of people theorized. Now, for my silver bugs out there, especially you guys who follow Wall Street Silver, you've probably heard Jim Lewis and Lee Justo been talking a lot in some of their recent videos about how the Fed just isn't going to taper. They're not going to taper. I wasn't so sure of that. I had previously put it at about a 50-50 chance that the Fed starts to taper this year. But seeing a jobs report like this, I'm going to lower my handicap of the likelihood of a taper down to about a 70-30 against. So I think there's only about a 30% chance that we start to taper this year now. Now, there's a big caveat attached to that because we have the expanded unemployment benefits are expiring. I believe it's today. It's either today or it's today. Today, the expanded unemployment benefits expire, which means that extra, I think it was $300 a week that the federal government was paying people not to work is going away. So that's a big question mark in the jobs market. Next month, the month after that, are we going to see huge gains? I don't know. But there's one thing I want to point out here in this headline that didn't get a lot of attention today. And that's this right here. Wages rose at a 4.3% year-over-year clip. Now, that's key because I did a couple of videos a few months ago, very early on in this channel, where I talked about how wages have to rise, how the fact that the price of everything is going up, all the asset classes are going up, day-to-day needs, food, shelter, utilities, all going up, wages had to increase. Well, we saw a 4.3% year-over-year increase in wages, and that's still not enough to draw people back into the workforce in any significant amount. So that's huge. Even though wages have risen 4.3% this year, people still don't want to come back to work. So how high do wages have to rise to get people to come back to work? That's a big question, and we don't know that because right now, these expanded unemployment benefits going away, that's obviously going to drive more people back into the workforce. How many is anybody's guess. And that's really going to determine the taper. It's going to determine these inflation numbers because I think you've got a lot of businesses out there right now that are waiting to raise their pay because they're hoping people come back to work when these benefits go away. If people don't come back, then those wages are going to rise further, a lot further. And keep in mind, I mean, even the CPI read, the government's actual inflation number is at 5.4%, and we all know that number is way, way low compared to what people on the ground are really seeing in price increases. So these wages, even though that's a pretty sizable gain, bigger than we've seen in a long time, it's still not even keeping pace with inflation, which means people's real wages, right, the purchasing power of what they earn is still going down. That's not going to draw people back to work. Sorry, wages have to rise at least keeping pace with inflation if you really want to draw people back into the workforce. So keep an eye on those wage numbers, because if the wages, if they don't go up, the unemployment is going to stay where it is, and this Fed asset purchasing is going to go on forever. If the wages do rise, it's going to add to inflation pressures. It's going to cause the price of everything else to go up. So, it really got to watch closely at those numbers. So, gold and silver, obviously, love this news today. And there's a couple of things I want to get into on this chart, because this may be the start of something big. Here is your daily chart. Let's move my big fat melon of a head. This is today's price action in silver. And look at that nice run this morning. A little bit of a pullback in the afternoon, some consolidation. I would expect that. But just a monster day, almost 4% in silver. And, the day's a long way from over, so who knows where that's going to end up. Now, I want to zoom this out a little bit. Let's go to a dailies chart. These are now daily candlesticks. And this is going back to about May. Let's back this out a little bit further. All right. So here's the price action we've seen really since those highs last year, and I want to put a couple of lines in here. Let's draw a line right here. There's our bottom around $22, right? We've tested that about 3 times now. And I also want to put a line around 28, because we've also struggled to recapture and to hold above that 28 and change line. Say that's probably drawn a little low. Let's move that up. There's our top there. So there is our range. All right, and we bounced pretty hard off of this 22 number. And I remember showing you guys on the monthly chart recently. Let's look at the monthly chart here. Let's zoom in on this. Here's that same range. A couple days ago, I did a video showing that hammer pattern, and it looks like so far the uptrend is in line with that hammer pattern. So we are moving to the north, which is long overdue. And there's a couple of things that I'm seeing that tells me between now and the end of the year, we may be heading back into this range. Now, this big drop started in June, right? This drawdown over the last few months, and then there's been some of those big Sunday night price smashes, right? We all remember that $400 million worth or $4 billion worth of gold or whatever that was dumped on Sunday night during minimum liquidity. But this whole stair step down started with the Fed in June announcing that they were finally talking about. All right? So this jobs report puts a big dent in that narrative. And if you look here, it looks like we're starting to stair step our way back up, basically reversing that trend of the Fed's taper narrative. So if we keep getting these data points that are going to make it harder for the Fed to taper, I see nothing holding us back from heading back up towards that $28 level. Now, there's another thing I want to talk about with silver that I also found very interesting. Now, this is in the Commitment of Traders report from the CFTC. Now, this data is a week old, but I want to zoom in. Let's make sure you can see here. Okay, right beneath my big fat melon of a head is silver. And I want to draw your attention to this line here. Because if you look, you've got your big pile of shorts here in the producer merchant index. That's your miners hedging. You'd always expect that. But look at swap dealers. That's your bullion banks. They're almost net neutral silver prices. The swap dealers have, since I've been following it, they've always been massively net short silver. This is the lowest net position I've ever seen in the bullion banks. That's interesting. Put a pin in that. We're coming back to that one. And the other thing I want to look at is managed money. That's your hedge funds, your institutions, right? They're net long, but again, they're just barely net long. Not very much, right? Only by about 11,000 contracts. And the same thing with other reportables. That's your family offices, wealthy individuals. They're net long by about 12,000 contracts. So why am I talking about this? Because the incentive for the bullion banks to smash the price, at least in this week-old data, is gone. It's virtually non-existent. There is not this massive net long position in the managed money or in the other reportables category that if the bullion banks were to do their paper price smash and drive the price down, there's not that many stop losses or margin calls to be had right now. The long positions are not that big. So there is very little incentive for the bullion banks to smash the price right now. And they have positioned themselves accordingly because, again, if you look at the swap dealers' positions, there are no long or no big net shorts for the bullion banks to defend right now. So put yourself in the mind of a crooked banker, all right? Boy, it's dark and it's smelly in here, but we're in the mind of a crooked banker. I have no vested interest in smashing the price right now. There's nothing to be gained from this managed money and these wealthy individuals. And I have no shorts to protect. So if I'm a bullion banker right now, I need to reload the magazine. I need to step back, let the price rise as it naturally wants to do, and wait for FOMO traders to pile in. So what I'm expecting, looking at this commitment of traders report, is I think the bullion banks may let prices rise for the foreseeable future, for the next couple of weeks or even months. And again, when I look at this chart, I see a chart that supports that we don't really run into any major resistance until $28. So we've got $3 and change of very little resistance. We've got the bullion banks have positioned themselves to allow prices to rise. There's no real vested interest in the bullion banks smashing the price. Now, if we were to go back to this commitment of traders report, if we were to see the managed money all of a sudden get ridiculously long, or the other reportables go ridiculously long, then I'd start to say, okay, we could have a price smash coming on the horizon, because then there's an incentive for the bullion banks to smash the price and trigger those stop losses and those margin calls. But right now, all the cards are aligned. And again, in the mind of a crooked trader, I need to step back and I need to let prices rise right now. So keep an eye on this commitment of traders report. If we see prices start to climb and we see the managed money and the other reportables start to increase their net longs, we'll probably see the swap dealers start to increase their net shorts as that happens, until it gets to such a big position when then probably somewhere around $28, the bullion banks go back to their stupid games. Now, the other reason I think they're incentivized to let that happen right now is we've seen a lot of physical buying during these most recent price dips. And the inventory levels on the COMEX are reflecting that. I mean, they're down to almost 100,000 or 100 million ounces in the registered category. And if that goes below that important threshold of 100 million, it could trigger a buying spree. And the bullion banks don't want to let that happen. So I think they need to let prices rise right now to kind of draw some of that silver back into the market to be available for sale right now. Because if you've got a large position in physical metal right now, you're not selling at $24 or $22, not when we've seen 28 recently. So again, I think the bullion banks are incentivized right now to allow prices to rise. That way they can lure in unsuspecting investors into SLV. They can lure in more managed money to go long in the futures market. So I see a lot of stars aligning in silver right now. Again, I have been so wrong about gold and silver this year. So I just want to throw that out there. I also want to throw out my butt covering statement. I am not a financial advisor. Don't touch a trade based on what you hear from me. Do your own research and your own DD. Arrive at a decision that's right for you based on your unique situation. And I also want to throw out there that, you know, I'm talking about paper trades right now. I'm talking about minor stocks. I'm talking about ETFs. All right. If you don't want anything to do with that paper madness and the crooked games that go on at the COMEX, if you just want to protect yourself from inflation, then there's no substitute for owning the physical metal. If you own the physical metal, then your wealth is protected. It's safely removed from their crooked banking system, and they can smash the price on paper all they want. You can sit there and hold it for years until the price eventually corrects, which rigged markets always fail eventually. It's just a matter of when. So I just want to throw that out there. And the other thing, if you are getting involved in paper trading in any way, whether it's ETFs, call options, and mining stocks or anything, I want you to keep in mind that markets can always stay irrational longer than you can stay solvent. And I can't remember whose famous quote that is. Maybe it's Warren Buffett. I don't remember. But when you see a rigged market, always keep in mind rigged markets can last longer than you can. Just throwing that out there. But I like the price movement in silver. I like the setup and the commitment of traders reports. We seem to be getting some data that says the Fed taper may not happen, which would reverse this stair-stepping trend down. So I see a lot of stars aligning right now. And, morale was kind of at an all-time high a few weeks ago on August 9th. You guys remember that Sunday night smash. And, a lot of people were just tempted to just give up and throw in the towel. They're never going to let the price go up. Oh, my God. And you could see it in the Twitter feeds. I follow a lot of these silver guys. It was pretty bottomy, I can tell you that, because the sentiment was more negative than I have seen since the beginning of the silver squeeze back in January. So maybe that was a bottom. I mean, maybe that all that madness on that Sunday night, that was the last of the price smashes by the crooked banks for the short term. I want to emphasize that they had finally positioned themselves to allow the price to rise. And we'll see where we go from here. But interesting times ahead. Guys, I want to thank you for your time. I want to thank you for checking out this video. I hope you enjoyed it. Please don't forget to thumbs up, subscribe to my channel, hit that notification bell. It would really help me out, help this channel to grow, and I would be forever in your debt. In the meantime, live small and dream big.